Welcome to the International Accounting. First time joining the program, remember to subscribe to the channel, like, share with everyone. Today we share with you exercises about calculate investment efficiency. Now, let's get started. Number 1. We have the information as follows. You have initial fund of €1,600,000 to invest. The current spot rate of Australia dollar is 62 cents. The 3-month forward rate of Australia dollar is 58 cents. The 3-month interest rate in the Eurozone euro is 3.5%. The 3-month interest rate in Australia dollar is 4.6%. Requirements. A. What is the yield to a European investor who decide to invest overseas by covered interest rate, CIA? Does the CIA work for the European investor? B. Would the CIA be possible for an Australian investor in this case? Solution. A. For European investor, convert EUR into AUD. 1,600 divide 0.62 equals 2,580 Australian dollars and 64 cents. Deposit 2,580 Australian dollars and 64 cents in Australian banks with interest rate of 4.6%. He gets 2,580.64 multiplied by 1 plus 4.6%. Equals 2,699 Australian dollars and 35 cents. Convert 2,699 Australian dollars and 35 cents into euro with forward rate 58 cents. 2,699.35 multiplied by 0.58 equals 1,565 euros and 62 cents. The yield of international investment for European investor, R equals 1,565.62 minus 1,600, divide 1,600 equals minus 2.15%. So covered interest arbitrage, CIA, does not work for the European investor. B. For the Australian investor, assuming that he has an initial fund of 1 million Australian dollars. Convert AUD into EUR. 1 million multiplied by 0.62 equals 620,000 euros. Deposit, invest, 620,000 euros with 3-month interest rate of 3.5%. He will get 620,000 multiplied by 1 plus 3.5% equals 641,700 euros. After 3 months, convert 641,700 euros into AUD with forward rate. 641,700 divide 0.58 equals 1,106,370 Australian dollars. The yield for Australian investor, 1,106,370 minus 1 million, divide 1 million equals 10.64%. So the covered interest arbitrage, CIA, works for the Australian investor. Number 2. A Canadian import company has to pay for imports worth $1 million in 1 month. The company enters into a contract to buy a 1-month USD over CAD call option with the following terms. Exercise price 1.2345 Canadian dollars. Premium 2 Canadian cents. Assume the spot price after 1 month can occur in the following situations. 1. USD over CAD equals 1.2821. 2. USD over CAD equals 1.2345. 3. USD over CAD equals 1.1904. Ask in which cases the company exercises the option and in which cases the option expires. Determine the amount of CAD to sell in each case. Solution. Option fee equals 1 million multiplied by 0.02 equals 20,000 Canadian dollars. If the company exercises the option, the total CAD the company must pay, including fees, is 1 million multiplied 1.2345 plus 20,000 equals 1,254,500 Canadian dollars. Case 1. USD over CAD equals 1.2821. This price will apply when the company does not exercise the option. Then the total CAD to pay, including fees, is 1 million multiplied by 1.2821 plus 20,000 equals 1,302,100 Canadian dollars, more than 1,254,500. In this case, the company exercises the option at the expiration date and the CAD paid is 1,254,500. Case 2. USD over CAD equals 1.2345, which is exactly equal to the actual price present, so in this case the company performs the contract or not. The same in the total CAD to be paid is 1,254,500 Canadian dollars. Case 3. USD over CAD equals 1.1904. The total CAD to be paid, including fees, is 1 million multiplied by 1.1904 plus 20,000 equals 1,210,400 Canadian dollars, less than 1,254,500. In this case, the company does not exercise the right at the maturity date and the CAD to be paid is 1,210,400. Number 3. A U.S. export company has a 1-month receivable of 100,000 British pounds. The company enters into a contract to buy a 1-month GBP over USD put option with the following terms. Exercise price $1 and 60 cents. Premium 4 United States cents. Assume the spot price after 1 month can occur in the following situations. 1. GBP over USD equals 1.58. 2. GBP over USD equals 1.60. 3. GBP over USD equals 1.64. Ask in which cases the company exercises the option and in which cases the option expires. Determine the amount of USD purchased in each case. Solution. Right fee equals 100,000 multiplied by 0.04 equals 4,000 United States dollars. If the company exercises the right, the total amount of USD purchased, after paying the fee, is 100,000 multiplied by 1.60 minus 4,000 equals 156,000 United States dollars. Case 1. GBP over USD equals 1.58. This price will apply when the company does not exercise the right, then the total amount of USD purchased, after paying the fee, is 100,000 multiplied by 1.58 minus 4,000 equals 154,000 United States dollars less than 156,000. In this case, the company exercises the right at the expiration date and the amount of USD purchased is 156,000. Case 2. GBP over USD equals 1.60 is exactly equal to the exercise price, so in this case the company exercises the right whether the contract is executed or not and the total USD purchased is 156,000 United States dollars. Case 3. GBP over USD equals 1.64. The total USD purchased, after paying the fee, is 100,000 multiplied by 1.64 minus 4,000 equals 160,000 United States dollars more than 156,000. In this case, the company does not exercise the right at the expiration date and the USD purchased is 160,000 United States dollars. Number 4. A company with international operations has the following balance sheet, column account, origin, USD, currency, EUR. Cash and equivalents, 50,000. Liabilities, 20,000. Fixed assets, 100,000. Owner's equity, 80,000. Request. A. Calculate the value of the original currency, EUR, for each account. B. Check if there is any difference in the balance sheet. If so, indicate and explain. Note, for the calculation, you can use the current exchange rate for the conversion between USD and EUR. Solution. A. Calculate the value of the original currency, EUR, for each account, cash and equivalents, 50,000 United States dollars per USD over EUR exchange rate. Liabilities. 20,000 United States dollars per USD EUR exchange rate. Fixed assets, 100,000 United States dollars per USD over EUR exchange rate. Equity, 80,000 euros. B. Check the difference in the balance sheet. There is a difference in the equity item with a value of 80,000 euros. This may be due to exchange rate fluctuations causing the value of equity to change. Note, in practice, auditing and adjusting international balance sheets can be more complicated, and the use of exchange rates is a market estimate. Number 5. Hypothetical company XYZ, an international business, entered into a purchase and sale of goods with a foreign partner on January 1. The transaction was conducted in euros, EUR. While the company's accounting books are primarily in US dollars, USD. Details: January 1. Purchase of goods worth 100,000 euros at an exchange rate of €1 equals 1 United States dollar and 20 cents. December 31. The exchange rate changes to €1 equals 1 United States dollar and 10 cents. Required. A. Calculate the initial transaction value in USD. B. Calculate the profit or loss after conversion at the new exchange rate. Solution. A. Calculating the initial transaction value in USD. Initial transaction value equals amount of euros multiplied by initial exchange rate, equals 100,000 euros multiplied by 120 United States cents per year equals 120,000 United States dollars. B. Calculating the profit or loss after conversion at the new exchange rate. Profit, or loss, equals amount of euros multiplied by new exchange rate, minus amount of euros multiplied by initial exchange rate. Equals 100,000 euros multiplied, 1 United States dollar and 10 cents over EUR minus 1 United States dollar and 20 cents over EUR, equals 100,000 euros multiplied, minus 10 United States cents over EUR, equals minus 10,000 United States dollars. So, the company will record a loss of 10,000 United States dollars due to the exchange rate fluctuation. Thank you for watching our channel. See you again in the next video.